Hello and welcome to Business Today. I'm Siddharth Zarabi and you're watching Easynomics. On the show today, we have a special guest, Upasana Chachra, the India Chief Economist at Morgan Stanley. We're going to discuss with her India's economic growth, prospects, and what is likely to happen in the coming quarters and beyond that as well. Upasana, welcome to the show. I want to begin by asking you for your overview, and there's a recent report that you have put out which captures it very well. But for all our viewers, how is India's economy performing at this point of time?
Thank you, Siddharth. Yes, so we just put out our mid-year outlooks, and if we take stock of where we see the Indian economy and also the outlook for the next few quarters, we think that on a relative basis, India is very well poised in this environment of external headwinds and trade tariff tension policies. Domestic demand-driven economies are poised better to face these challenges, and within that, India with its strong domestic demand strength, driven by consumption and capex, is looking pretty well placed. On top of it, some of the incoming data that we've got in terms of the March quarter GDP numbers have shown a beat. They have been better than anticipated at GDP of 7.4, expectations of around 6.8. Incoming high frequency data is also looking decent. We saw GST collections for May getting reported earlier this month, and they clocked a growth of above 16%. So pretty healthy set of numbers coming in from a domestic demand perspective. I think the outlook is a bit cautious only due to these external headwinds. Our global team does expect a moderation in global growth, and in that context, I think it is India's growth may also see some moderation driven by the external factors, even as domestic demand remains pretty solid.
Upasana, there's one view which says that India's economy has in fact seen some sort of extraordinary improvement in the recent past, with one analysis saying that the average for 2 years of growth is 7.85%, way above the 6.5% long-term trend, and that this means that India is above the 7% growth rate of what is called a miracle economy. Do you agree with that view?
See, fiscal 24 was very strong for India in terms of growth numbers, and you saw quarterly numbers pretty much consistently above 8%, and therefore the full year number has been, I think, close to 9% when the government has revised it upwards recently. And therefore, when you look at 2-year CAGR, you'll get these numbers, which is going to be plus 7%. So from that, and I think there's no denying that post-pandemic, the Indian economy has shown pretty good resilience and a sort of smart recovery post the pandemic led shock, driven by different levers, be it government infrastructure push or strong strength in the services export segment and recovery in consumption as well. So, I think a lot of factors have come together for the Indian economy to deliver strong growth. And the key would be that, we continue to sort of maintain the momentum. So, yes, I think last trailing 2 years have been pretty solid for India.
Okay, and viewers, this is perhaps all the more remarkable because if you look at other emerging economies, and I'm not even talking about near India economies, I'm talking about the broader emerging economies classification, clearly India does stand out. Let's take a few specific themes further, Upasana. First of all, your assessment of how manufacturing is doing. There is very clearly a lot of effort that the government has put in. There is fiscal support also that has been put in, but yet the numbers don't seem to perhaps provide us a very rosy outlook. What's your own sense of how the manufacturing engine is performing?
Well, you're right, Siddharth. I think on the manufacturing side, we have seen a lot of policy measures being taken up. from the times of the pandemic with and probably a little before that with the corporate tax rate reduction firstly, which helped to sort of make the level the playing field even for India as well, as it was competing with other EMs to integrate with global supply chains. We've had the PLI schemes, or the production linked incentive schemes, with a specific focus on manufacturing sectors. The government is targeting close to 14 plus sectors under these schemes with fiscal incentives. Again, something which is pretty novel. Like we've not really gone down that path earlier, and therefore there has been concerted effort to push manufacturing. Lastly, the government has been pushing for improved infrastructure, especially physical infrastructure access, which helps to reduce your costs of doing business, especially like logistic costs of doing business. So I would say that a lot of measures have gone through. When we look at the broad macro metrics, say things like manufacturing to GDP, yes, that hasn't really shown in numbers that it has accelerated since these measures have taken up. We're still meandering around the 14 to 15% level of GDP for manufacturing segment. Ideally, we would hope that to go up. If you look at some other metrics, say India's market share in goods exports, again, it remains sub 2%, not somewhere we should be hoping to be. We should ideally be looking at more massive gains in exports market share on the goods side. It is a little better versus pre-pandemic, but not meaningful, about 20 basis points better. These metrics will definitely show that in terms of real data, we still need to do probably more for improvement to flow through. Having said that, I think we are still seeing some pockets of success, like the mobile phone exports, being an importer to now it being one of the number one, or rather the number one export in terms of the commodity segments on the goods side in the trailing 12 months. That has been a pretty phenomenal story. So I think, you'll have to probably assess it in terms of the sector-wise segments where we can see the benefits accrue of these policy measures, and also probably in context that globally, the growth environment has not been one of the best, wherein massive capacity additions or manufacturing capacity additions in India can take place. It's not the same environment as in when some of the North Asian economies expanded and put in their manufacturing base. So the context is also very different for India in this current cycle.
Upasana, investment, which is a major driver of growth, is also doing well. If you look at the latest number, GFCF grew at 9.4% in FY25, and the annual rate at 33.7% is the highest since FY13. Do you think the concerns that we had till recently about high government capex and how it might have been crowding out, that has now reversed and private investment has kind of fully picked up?
See, I think on the capex side, yes, we have seen pretty good numbers on the capex growth, especially in the last quarter as well, when the March quarter GDP numbers, capex to GDP inching up, and that has been driven, I think, to an extent by, I would still say, the role of government capex has been pretty dominant, even in probably the last few, or if you look at the March quarter numbers, because government capex, after having a slow start in fiscal 25 due to the election-related disruption, has sort of been catching up in the latter part of the year, and especially in the March quarter, we've seen sort of meaningful rise by the government to not only meet but rather exceed its revised estimates on the capex side. So I think government capex still probably has played a good role. Household capex as well. So real estate cycle remains pretty decent. We've probably seen some sort of a mid-cycle consolidation, but net the cycle remains strong. Private capex, I would say, I can be cautiously optimistic. We don't really have the national accounts level breakdown to say how much private capex would have picked up at in fiscal 25, and the high frequency data that we get, say, from CMIE or other sources will not be very telling of a major pickup in the in the private capex cycle for fiscal 25, and therefore I think that I would be cautiously optimistic on its role. But having said that, yes, some segments on the private capex side, if you track high frequency data like manufacturing or steel, cement, some of the newer themes like energy transition have seen capacity additions, which should be flowing through into these numbers as well.
Upasana, since we are talking about investment, Morgan Stanley had its annual India Investment Forum. Now, as I understand, it was off the press, but may I ask you about what sort of came out of it? What was the response like? What can you share with our viewers?
Yeah, so we're in the middle of our investor summit, and it's an annual event wherein we get not only investors but also corporates. I think the mood remains pretty buoyant, and as I mentioned at the start, we have this steady, consistent story that on a relative basis, India is best poised to deal with these trade tariff tension policies. And I think in an environment where growth is getting more and more scarce, India's 6% plus growth rate, even if it's a tad weaker than where we were anticipating 6 months back, looks very decent, and the domestic demand story remains very something which is very interesting to investors here at the summit.
And just to dial back on that point and connect it with what you are hearing from companies at the investment forum, has government capex actually crowded in private sector investment, driving companies to sort of focus on sectors where the government was prioritizing investments? And from the corporates that you might have interacted with, do they see that as a sustainable theme for the near future?
So, I think that has been sort of an ongoing theme wherein the government has used its balance sheet to sort of counter-cyclically push capex. Rightly so, post-pandemic, it's very hard to imagine the private sector take that lead, and therefore the government has rightly taken its push on physical infrastructure. That has helped to, drive investment or capex in some of the related segments. So, as I mentioned earlier, steel, cement, or the construction-related segments on the private side are also seeing these capacity additions. Or you would see the same in terms of order book inflows for some of the segments which would be physical infrastructure related, like on the railway side and the related segments. And I think this theme should continue. That's sort of the feedback and our own sentiment as well, that as government continues to prioritize capex, that will help to filter through into some of this private sector capex activities as well. And we see that continuing because, the government's balance sheet still remains in a decent position wherein it can target sort of mid-teens on the capex growth and still manage to achieve, sort of a gradual pace of fiscal consolidation.
Let's turn our attention to inflation. We've had a pretty decent, and some would say perhaps more than that, start to the monsoon. Things appear to be much better than what we were assuming earlier. What's your outlook as far as the inflation dynamic is concerned?
I think on the inflation side, we've got good news. We've seen data points moderate in the last few months. On a calendar year to date basis, inflation is tracking, sub 3.5 or around those levels on an average, and sort of consistent downside surprise versus estimates. A large part of it driven by the food inflation. So, food inflation, which has been a problem in the trailing 2 years, has now sort of finally turned. And the good monsoons and rainfall of last year, which has helped to improve the crop production for both summer and winter crop, is feeding into this easing food inflation environment. Definitely the forecast that this year's monsoon will also be above normal helps so at least maintain that outlook. And I think that is the key factor that is helping to keep the outlook on inflation pretty benign for the next few months, or you can say for fiscal 26. We do expect inflation to be decisively below 4% in calendar year 25. I think next few readings could be in a range of 3 to 3.5, pretty benign therefore. And also, probably downside surprises could be the norm in the next few months in terms of inflation. On the non-food side as well, we don't see any major risks or worrying factors. Global commodity prices have been range bound, oil prices have been range bound to low or lower on a YOY basis. The outlook also doesn't seem very threatening, and therefore I think if you look at both food and non-food, there is enough comfort that inflation should align durably to RBI's medium-term target of 4% when you think about, like, say, 12 months ahead.
Viewers, this point is very, very significant because from a monsoon point of view, a record Rabi crop can be expected, and that will definitely have an impact on rural consumption, and a bumper kharif for production also on account of a good monsoon. Just a quick point on rural consumption. What do you expect to happen? The rural consumption levels are already robust. Do you think a significant pickup can be expected on account of this factor?
So I think rural demand has been doing better than urban and also improving if you look at, like, last 12 months data. I think that story should continue. I think it should sustain at these sort of robust levels from here on, because it does have the tailwinds of good monsoons and therefore support to farm incomes from the agriculture side continuing for another 12 months. And that'll be good news, because, sort of back-to-back crops being good in 2 consecutive years and 4 seasons as such will always help both the rural incomes and the demand side of the story. The second is also that as inflation comes down, purchasing power improves, and we do know that helps the rural or the bottom of the pyramid the most in terms of improving purchasing power. And that is also another theme or another tailwind to rural demand for this year. So I would say we've already seen some amount of improvement, and I would expect that to be sustained, and these tailwinds to help maintain that momentum.
So while you are at the Morgan Stanley India Investment Forum, we are also, viewers, at a time when the monetary policy review has started. Given the inflation dynamic, given the growth dynamic, how do you expect the MPC to read all the data, and what policy approach can we expect?
So our view is that RBI and the MPC will remain decisively on the easing side. We've already seen that change from the RBI in the last two policies as well. They have lowered rates by 50 basis points or 2 rate cuts till now, added ample durable liquidity or upwards of $100 billion on a calendar year basis, and dialed back a bit on the regulatory tightening and the concerns on the regulation side as well. So I think more of this will continue. I think for the June 6th policy, we are expecting a 25 basis points rate cut, continuing with the accommodative stance. I think on liquidity, that's not necessarily has to be announced on the MPC day itself, but I think a calibrated approach towards adding liquidity as and when needed to maintain system liquidity and surplus will continue. And I think over time, probably some more dialing back on the regulatory tightening could also come through, which should help support credit demand as well. So I think RBI is going to be looking at trailing data, which will show that inflation has eased. Growth, yes, has surprised positively, but when you look at the forward-looking data, it will probably get more comfort on inflation, that inflation is likely to be below 4%. Outlook on growth, RBI has a number of 6.5, so I don't see that changing. But at the same time, given the external headwinds, the outlook on growth is therefore cautious. And I think when you put the two together, there is enough reason to continue with the easing stance and therefore to cut more. So yes, we do expect one more in June and probably another rate cut in August, and therefore we look at a cumulative 100 basis points of easing.
A cumulative 100 basis points of easing, viewers. Take note of that, because very clearly on the rate cut front, further easing as well as more relaxations by the RBI under new Governor Sanjay Malhotra on measures as far as liquidity and even easier regulations are concerned. I want to come back to something that you briefly touched upon, and this is the broader trade context, including the trade deal. We've heard several signals so far which seem to suggest that a first phase deal is likely to happen very, very soon. Assuming that happens, does trade and the consequent disruption that the United States seem to have unleashed, there's a lot of back and forth, as you well know, does that remain a significant risk factor for our growth projections, or will we deal with them and absorb it in the due course?
So, well, I think to the extent India's trade with US is concerned, I think we are less concerned about that. So I think the direct impact of these tariff policies in terms of higher tariffs that were initially imposed and then paused, and then you'll be working towards a deal to get through a bilateral deal with US will minimize the direct impact that India's exports to US were going to face. Just to recall, India's exports on the goods side to the US are not that large. It's about 2% of GDP. Therefore, any direct impact is going to be limited. We have always highlighted, and we worry more about the second order impact, which is, like you have pointed out, what this whole trade tariff policy tensions means for global growth, for US growth, and also the business sentiment. And I think that is the key worry. As I mentioned, our global team does expect a slowdown in global growth. So our numbers indicate about at least 100 basis points of slowdown from December 24 to when we reach December 25 on the global growth basis. And India's exports to GDP are at about 21%. And therefore, it's not that we will be totally unscathed by this moderation in global growth. And that is, I think, the indirect channel which we need to look out for and get, where we worry. The direct impact, and especially in context that there will be sort of some early harvest deal with the US before the July 8th time for the pause of tariffs, does minimize any damage that could ensue just on the direct bilateral trade basis. It is the indirect impact that we should be looking out.
Upasana, one final point, and I am sort of going back to fiscal policy, and in some ways it's a little early to talk about what is likely to happen towards the end of the fiscal year, which is when we will hear from the government in the budget as to the priorities for the subsequent financial year. But given the better than expected performance to some extent on tax collections, RBI has also been very generous. How is the overall fiscal situation looking like to you for the current year? And if this were to continue, what kind of policy priorities do you expect the Finance Ministry and the Government of India to continue to pursue?
See, I think the fiscal balance sheet for the government remains in a pretty decent spot. It is still really very early days to judge this year's fiscal data. We've only got 1 month's data, but the government has maintained its momentum on capex spending, which I think is good news. Yes, the trend on like indirect taxes, GST looks good from what we know from April and May. What we know from RBI's dividend check to the government also gives comfort that there is enough buffer if there was to be some hits and misses on the revenue side. So I think it makes us comfortable that the government will be able to meet its fiscal deficit target of 4.4% of GDP for fiscal 26, and at the same time ensure that the capex spending momentum is maintained and that they meet the budgeted numbers. So I think at a point in time when the Indian economy was going through a period of slowdown, there was concern that whether they will be able to balance the consolidation with the increase in capex that has been budgeted. But I think that has got now allayed with these incoming data points, and I think that is the best situation to be in. If we were to see continuous, upside surprises on the revenue side, then as far as we've seen the government's priorities till now and the way they have used it, it's probably going to then better their fiscal deficit consolidation, maybe a tad a tad higher than anticipated. But I think for now, that's something that is still too early to call out for. I think what I would say is that we are in a good spot to balance both consolidation and meet capex spending.
I think that's the perfect note to end this conversation on. A good spot, really, and we started by me raising the point about 7% and sort of a miracle economy status, but we'll have to wait for the full year to pan out. But Upasana Chachra, thank you very much for joining us from the Morgan Stanley India Investment Forum and taking out time to talk about India's growth, inflation, and other aspects. Viewers, with that, it's a wrap on this conversation. We'll slip it to a short break. When we come back, we'll continue with other news and views just after a very short break. Do stay tuned in.
"45 days after the April 22nd attack in Pahalgam, and a month after India launched Operation Sindoor in response to the terror attack, Prime Minister